So in this video, I'm going to take a look at one of the most basic technical analysis pieces of the puzzle, if you will, and that's trend lines. First, we need to define a trend line before we talk about trading trend line breakouts or breakdowns, which is the actual topic of the video. You can see I have a line on the chart, and this is the DAX weekly CFD. You can see that we have touched this line several times. There's a couple times here, 4 or 5 times there. Once there, and you can see that the trend line has offered support when we have tested it. We didn't quite touch it there, but same idea. It gives you an idea of um, where the buyers are interested. Also, you have to keep in mind that this is a longer term trend line, so that is something that gives it a little bit more credence, because the volume of trading is much more significant than, say, on like a 5 or 10 minute chart or something like that, because it takes more orders to form these candles. So with that, it looks like the uptrend has held quite well. And this is a very long-term uptrend. This was from January of 2003 all the way to December of 2007. So you can see that we were finding all of this support. Now the question is when you break the trend line, how do you trade it? Now there's a couple different ways people will trade it. They will either place a trade as soon as we break the trend line, which is the quickest, most volatile, most risky way to do it. You can see it eventually did work out in this case, but you would have been taking a loss at one point, assuming that you didn't take profits. Another thing that people will do is they'll wait until they get a candle close below the trend line. So, for example, one of these candles, you could have shorted there. And then the most stable way, probably the least riskiest in theory at least, is seeing a retest and then a confirmation. So this was support, and market memory suggests that we find support every time we touch it, but once you break down through support, it should become resistance and vice versa. So on the breakdown, on the one part here on the chart, you can see that we fell to 2. From 2, we bounced to 3. 3 retested this trend line to see if it was in fact going to become resistance now, and it did. And as we drift lower, it was a sell signal. Sometimes people will even go so far as to wait until you break down to make a second low, in this case after a breakdown, but really a lot of people will just wait till the third. That confirms that we have in fact broken down pretty significantly, and that the downward pressure continues. You can see that this trend line breakdown really fell apart. Now, in full disclosure, this was part of the financial crisis, so of course it was pretty strong from several years back. But this is a classic trend line type of analysis where you can see that the buyers had comfortably found this support, and then once we broke down, there were a couple different ways to trade it, all of which gave you the same results. The main reason why you don't want to take the immediate breakdown is because you can see they gave back all of this during the week. So if you would have taken it right away, you would have seen pretty decent profit and had it snap right back in your face. If we would have kept going higher, that's what is known as a false breakout, or in this case breakdown. They do happen, so that's why you tend to wait for some type of confirmation if you're a little bit more careful as to how you place your trades. This is one of the most common forms of technical analysis. Matter of fact, trend lines are in almost everybody's charts, no matter what system they use. So really, if you want to do any technical analysis at all, you have to be comfortable in using trend lines and understanding exactly what they represent.